Hi there, my name is Matthew Goldsack, Head of Investment Solutions at BT Funds Management, the investment arm of Westpac here in New Zealand. In this update, we wanted to share with you our views on some of the key drivers behind market returns for the 3 months to the end of June 2017. Now, we've had quite a strong start to the year across most of the major asset classes, and therefore investors with diversified portfolios such as KiwiSavers would have noticed their balances being a little bit higher of late. So what's been going on? Well, generally we've had some pretty good economic data to contend with. Economies have continued to grow and data generally has been released that has exceeded expectations. Now in the US, for instance, unemployment is falling, incomes are rising, and President Trump's policies, particularly his plans for tax cuts and spending, are generally regarded as being positive for future growth. So rising rates of economic growth are generally good for company profitability, and so when you take into account that interest rates around the world are still at very low levels, investors have flocked to equity-like investments such as shares and property, seeking out higher returns. Now the problem with all of this is that some investments are becoming more and more expensive. Shares have had an exceptionally strong run in the last few years and valuations look quite stretched relative to history, and therefore a cautious approach is warranted. So let's look at the markets now. Now, shares and property performed well for the quarter, with the domestic share market one of the world's strongest performers, gaining almost 6% for the quarter and 11% for the year so far. Globally, Japan and some of the emerging markets were also very strong. At home, there were some of the less known names within the main index that performed the strongest. A2 Milk and software company Xero, for example, both gained around 30% for the quarter. Within fixed income markets, returns tend to be driven for the most part by movements in long-term bond interest rates of governments and companies. The June quarter saw long-term bond interest rates little change, and therefore we had only a modest upwards movement in bond values for the period. Now, as we look at the rest of the year, there is potential for some volatility in asset prices. Now, investors don't like uncertainty, expectations are high, and therefore any disappointment both in terms of data releases and policy could impact markets, and therefore investors should be prepared to see some movement in the value of their portfolio over coming months. In this type of environment, it's important that investors remain focused on sound investment principles, avoiding the temptation to make major changes to their investments in response to news or to events that might be short-term in nature. Thank you for your time. If you want more information or would like any financial advice regarding your particular financial situation, please contact a Westpac financial advisor.